Hello, everyone. Welcome back to another episode of the Week in Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, quick reminder, hit that subscribe button for all the latest content from us. And if you're out there looking for a second look on your portfolio, on your financial plan, now is the perfect time to reach out to us at Creative Planning. Go to creativeplanning.com/Charlie to schedule a call or a meeting with an advisor. Receive a free wealth path analysis from us. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over $370 billion in assets under management and advisement, and we're here to help. So reach out to us today, creativeplanning.com/Charlie. What's on the docket for today? A lot to talk about. This is the biggest story, the return of easy money, the expectation that the Fed is going to come in and start cutting interest rates again. It's all the same trade. I'm going to talk about how the markets responded to the Federal Reserve speech, Jackson Hole, Jerome Powell, all the same movement in terms of markets. I'll talk about that. Is the Mag 7 concentration justified? This is the big question everyone's asking. I've been talking about increasing concentration, but is it justified? Let's dig into that. The best and worst of times in retail. Looking at the chart that I'm going to show you, you can see some companies doing very well over the last 5 years, other companies not so well. Housing market is flatlining. We're seeing inventories go up, appreciation go down. We'll discuss that. And we'll end with something positive. As we always do, records are made to be broken. Historic record in the Dow has been broken. Unbelievable. We'll talk about that at the end of the show. The return of easy money, biggest story in the markets right now is the Federal Reserve. The expectation is they're going to come in September and start easing again. And why are people expecting that? Well, Jerome Powell's speech in Jackson Hole was viewed to be very dovish. And here's the key sentence here. The balance of risks appears to be shifting. And what that essentially means is the Fed is going to start to worry more and do policy more based on the weakness in the labor market than on inflation. So they have two mandates, of course. That's price stability and maximum employment. And they've been worried about price stability all year long, and for good reason, because inflation has never reached their 2% target. But here they're saying, well, we're going to forget about that inflation part, and we're going to start easing policy because we're worried about the labor market. And really, they're worried about the labor market having a worse than expected outcome here. And they're saying, essentially, if these risks materialize, they can do so quickly in terms of sharply higher layoffs and rising unemployment. So even though we haven't seen that in the data, we're not seeing mass layoffs yet. We're not seeing a big spike in the unemployment rate. It's still pretty low at 4.2%. The Fed seems to want to get ahead of that weakness by continuing to ease policy. And they view policy as still restrictive here. So it may warrant adjusting our policy stance, is essentially what he said, but the markets interpret that as we're going to adjust our policy stance in September. And if we look at this chart right here, I think this is what the Fed is going to be pointing to if they cut interest rates in September. They're going to say the labor market's weak here, only 1% growth in terms of payrolls over the last year. That's below average. The average about 2% historically. And so we need to get ahead of this and start easing policy again. And in doing so, if the Fed does cut in September, they'll be essentially admitting that their 2% inflation target is a farce. Over the last 5 years, we've seen inflation more than double that target. And this didn't stop them from cutting interest rates 1% last year. And it seems like it's not going to stop them from cutting interest rates once again here in September. And if we look at the cumulative rates of inflation, well, this pretty much tells you, well, of course, the idea of a 2% annualized inflation rate is complete nonsense. If you take the cumulative rate and you annualize any of these much higher rates of inflation in car prices, shelter, groceries, everything, then that 2% target would imply. And if we look at the expectations, and this is really what matters heading into that meeting. The meeting's not until September 17th, so of course this could change. But if the odds are this high heading into that meeting, if it's 85%, 90%, or higher, you're likely to see the Fed cut interest rates. They don't like disappointing the market. Every single meeting since 2009, the Fed has done exactly what the market was expecting to do heading into the meeting. And in terms of the longer term expectations, while the market's expecting not just a cut in September, they're also pricing in another interest rate cut before the end of the year. And so that would bring the Fed funds rate down below 4%. And in 2026, they're actually expecting a few more cuts, and they're expecting the Fed funds rate to end that year at 3%. But of course, you have to throw out these longer expectations. They're all often wrong because so much can change between now and the end of 2026. The only predictive power in terms of what Fed fund futures are telling you seems to be in the short run, seems to be in that next meeting. So as we get closer to that September meeting, we'll look at the odds. If they remain high, a cut seems to be the most likely scenario. And it'll be interesting how the Fed talks about cutting interest rates despite inflation moving away from their target, which is likely to be the case. So we're going to get two more inflation readings before the next FOMC meeting. One is going to be at the end of this week. It's going to be the PCE report. That's likely, according to the Cleveland Fed, to show an increase in core PCE, which is their preferred measure of inflation, increase to 2.9%. And the CPI report, what is the Cleveland Fed projecting here? An increase in overall CPI to 2.8%. That would be an increase from last month at 2.7%. So if the Fed cuts interest rates, they're going to have to find a way to say, well, we have to ignore the inflation side because we believe that the labor market is weakening and we need to get ahead of that risk here. And what they're going to point to is a Fed funds rate that's still above that core PCE rate by an amount they consider restrictive. So they're saying it's still restrictive policy, so that even if they cut 25 basis points, that in their mind doesn't mean the Fed is shifting to an easy money policy. It's just less restrictive than before. And if we compare the Fed to other global central banks around the world, you could say that the Fed has been showing at least more restraint than these other central banks around the world. Looking at the real central bank rate, the U.S. is among the highest in the developed world at 1.7%. So 1.7% higher is that Fed funds rate than the rate of inflation. You can see we have countries that have a negative real Fed funds rate. Japan, Denmark, Switzerland, all negative. The Eurozone is flat, so their central bank rate at 2% is exactly where their inflation rate is. The UK just slightly positive. So if we look at these other countries, if you're just doing a comparison, you would say, oh, the Fed has room to cut to get closer to where these other central banks' rates around the world are. You know my view on this. I don't believe the Fed should be cutting interest rates. I think they should be focusing on that inflation side. And we haven't got to that 2% or even close to that 2% if we're looking at the last 5 years. But the Fed will do what they want to do, and they always have a bias towards easing. There's a lot of pressure on the Federal Reserve, obviously, to cut interest rates for many different reasons. So for all of those reasons, it seems like a rate cut, unless something changes in terms of that employment report that we're going to get in early September, or the CPI report or PCE report become in unusually high, it seems like they want to start easing monetary policy again in September. That brings us to it's all the same trade, this fascinating thing that seems to happen whenever there's a dovish statement from a Fed official, whenever there's an interpretation that the Fed will be easing policy again. What you tend to see is everything moving in the same direction, the dollar going down and all asset prices going up. And I just want to highlight this again because it's just so unusual to see the Fed cutting interest rates with this backdrop, with stocks at all-time highs, home prices, crypto, gold, money supply, national debt, and you have inflation at 2x the target, and the Fed is still cutting interest rates. Highly unusual. And what the market's essentially saying in terms of it's all the same trade is there's going to be more debt. Those deficits are going to continue. The money supply is going to continue to go up. There's going to be easy money. We're going to inflate our way out of this situation. It's going to lead to your currency being less valuable, and all else equal, that's going to lead to asset price inflation. And this is what happened when Jerome Powell was speaking. We saw the dollar go down almost immediately, finished down about 1% on the day last Friday, and then you saw every asset class moving higher: gold, large cap stocks, small caps having a huge surge higher, and Bitcoin moving higher as well. In terms of volatility, it's just been absolutely destroyed, absolutely crushed. Lowest level for the VIX here at 1422 that we've seen all year. That's down from over 60 on April 7th. So just a stunning move from extreme fear to now you could say no fear at all in terms of volatility. And if we look at the last 20 weeks in terms of this volatility index, the VIX, a record crash in terms of volatility, 69% decline in the VIX over the last 20 weeks. We've never seen anything like it in the history of the VIX. You can see here the other dates here, and I went back in time and said, well, what has the S&P 500 done over the next 6 months, 1 year, 2 year, 3 year, 4 year, 5 year? And you can see a year later, every single time the market's been higher. Doesn't mean it has to be higher this time, but clearly a big decline in the volatility index has not been a sell signal in the past. You actually have seen better than average returns going forward. And I've shown different versions of this chart in the past few months. I've also shown strong move higher in the S&P 500. And the basic premise behind it is simply strength tends to beget strength. So an extreme move higher tends to be chased by investors, speculators, market participants, and you tend to see the move continue in the direction. Of course, it won't continue forever. There will be a high that is a high before a bear market again, but historically, these big crashes in the VIX have not been a sell signal looking out the next few years. If we talk about asset classes here, a rising tide has lifted all boats. So once again, it's all the same trade. Market loves the idea of the Fed being easy, particularly easy in a situation where we're not yet in a recession. We still have low unemployment. We still have the stocks, housing market at record highs. And you see this easy policy, and the market is really embracing it here with every asset class from gold, commodities, crypto, stocks, bonds, preferred stocks, high yield, investment grade, everything moving up together in tandem, credit spreads tightening, and you're seeing everything benefit from this idea that the Fed is going to be cutting interest rates in September. And you have the aggregate U.S. bond market now up about 5% on the year as we're seeing interest rates move lower. So they're getting a boost from that as well. So let's talk about the Magnificent Seven here. Is the record concentration that we're seeing in these 7 names justified? And I've been talking about this phenomenon. We're seeing the biggest stocks make up a bigger and bigger share of the S&P 500. You have NVIDIA leading the way at over 8%, biggest for any one stock in the index in history, data going back to 1980. If you look at the top 3 stocks, NVIDIA, Microsoft, and Apple, they make up 21% of the index, also a record high, and the top 10 stocks are at 38% of the index. If we zero in and just look at the Mag 7, this is the big question. 34% of the S&P 500 is in these 7 stocks here: Tesla, NVIDIA, Meta, Microsoft, Google, Apple, Amazon, 34%. So do the fundamentals justify the weighting? And there's different ways to look at it. One would be to look at it in terms of revenues. I don't think this is the way you should look at it, and I'll tell you why. But if we look at it just in terms of what are their revenues as a percentage of the S&P 500, you can see here nowhere near that 34% weighting. It's about 12% of the S&P 500's revenues come from these 7 companies. But the reason you see this enormous gap, 2 reasons. Number one, and this is the big one, these companies have much higher profit margins than the overall S&P 500. So their revenues are not going to be as comparatively high because they're much more profitable on a lower revenue base. The second reason is the expectation is these companies are going to grow their sales at a much higher rate than the overall S&P 500. So they're going to grow into this 34% weighting. So which leads us to what you should be looking at when it comes to is this weighting justified? And that would be net income, looking at actual earnings, profits here. You could see still a gap, but much smaller here. 34% weighting in the S&P 500 based on market cap, and net income you're at 26.6%. So why do we have this gap? Why are investors bidding up the shares and making them 34% of the S&P 500 when their net income is only 26.6%? Well, investors are very optimistic, of course, about the future prospects of these companies. So they're expecting a company like Nvidia, you could see 8.1% of the S&P 500, only 3.8% in terms of net income. Investors are expecting that number to grow, this 3.8% to grow in the next few years substantially. And if it doesn't, if these high expectations don't materialize, well, then you have a problem, right? Because then you have this number on the right side, this combined share of net income going down or staying flat, and you still have this high weighting in the index. But in terms of is it justified, it really comes down to that question. Do you believe that the expectations of investors are correct? Do you believe we're going to see these companies continue to outpace the S&P 500 in terms of their fundamental growth? Because there's no question over the last decade, if you look at the earnings growth of these companies, you compare it to the S&P 500, it's multiples higher. And there's no question today investors, because of that, are assigning a higher valuation of these companies. The only question is, do you think that the expectations are too high? Do you think that these price to earnings multiples and price to sales ratios that we're seeing on these companies are too high, that they won't be able to grow into them? So you're talking about here Tesla at 197 times earnings, Palantir nothing even close, 487 times earnings, Nvidia, Netflix over 50 times earnings, and Apple, Amazon, and Microsoft above 30 times earnings, and the price to sales ratio, you can see all of them above the S&P 500. So that's the question for investors. Is this gap justified? It's probably not as big as you might have thought it to be. So a lot of the share, a lot of the weighting of the S&P 500 is simply the fact that these are the most profitable companies in the S&P 500. The question is, do you think that market participants are overly optimistic in terms of will these companies continue to outpace the market in terms of their growth rates? Let's talk about retail here. It's been a big story in terms of, is it the best of times? Is it the worst of times? There's a lot of conflicting headlines when it comes to the U.S. consumer. And what you often probably hear of late is that the consumer is extremely negative. If we look at consumer sentiment, 58.6, University of Michigan, that, if you look at just that number, you would say we're probably in a recession, or we're a period of very high inflation that we saw in 2022, because in the past, the only times we've had readings this low were during those periods of time. But if we come to today, consumers very, very grumpy, and it, based on just the data, you would question, why are they so negative? And if you look at, if you dig into why in the survey they're so negative, there's two reasons. One, they're expecting inflation to be pretty high over the next year. So they're expecting tariffs or other factors to lead to higher prices. So they're negative about that. And they're also expecting, if you look at the survey data, unemployment to go up. They're expecting the job market to weaken. So they're similar to the Fed. They're saying we're going to see weakness in the economy. We're going to see actually above inflation be well above average over the next year, and that's causing them to have a very low sentiment level. But as I've been saying, if you watch what they're doing instead of how they're responding in these surveys, they're still spending. So they're not pulling back based on these negative views of the economy. They're still very much spending. If you look at retail sales, up 3.7% over the past year. If we adjust it for inflation, which is really the number you should be looking at, up about 1% over the past year. So no signs yet of the U.S. consumer pulling back because of these negative views. What they are doing, though, is shifting where they're doing their buying. And I think this chart really illustrates it here. Over the last 5 years, you have Costco and Walmart, two of the big winners here, taking market share. And you can see their share prices really reflective of that. Costco up 217%, Walmart up 149%, both better than the S&P 500's return, 103%. And you can see here, Target, one of the big losers, losing share, flatline in terms of revenue growth, down 27% over the past 5 years. So depending on who you are, this has been a very good period for retailer or a very bad period. But overall, the consumer still spending. They're just changing where they're spending. And that's always the case. There's always a shift in terms of the consumer and where they're spending. The interesting thing will be when we do have an economic downturn, well, how bad is this sentiment going to get if it's already this low? That would be crazy to see that we really haven't seen a recovery given the strong financial markets in the past year. we've always seen this recover and move more in line with the stock market. This is really the first time in history that we're seeing this type of deviation despite the market being at record highs. Let's talk about the housing market here. Peter Maluk and I did an episode of Signal or Noise. I'll have a link in the show note talking about the U.S. housing market, talking about how to make housing affordable again. So check that out. And what we're really talking about is this chart right here, the huge gap we're seeing between the amount that you need in terms of household income in order to afford a house and what your actual household income is. So this gap has never been wider. It's 57%. So you need about 124,000 to afford the median price home for sale in the U.S. But the median income in the U.S. in terms of households is only 79,000. So needless to say, this is an untenable situation. You don't want to see a gap be this wide, and you can see it's persisted over the past few years. It hasn't contracted. We haven't seen this gap close. We're just seeing it widen. And what that's led to is an absolutely frozen housing market. And if we look at transaction here, this really illustrates this. Existing home sales flatlining at around 4 million. That's about the lowest levels we've seen since the financial crisis. So we saw a little bit lower a few years ago, but pretty much the lowest levels we've seen. So we're seeing very few people actually buying homes, actually transacting in terms of homes because of that very low affordability factor. Now, here's the good news if you're a potential home buyer, if you want to see that affordability gap start to be closed, the way it will be closed is with prices to normalize and at least not go up way higher than the rate of inflation, which is what has happened over the past decade. And what we're seeing here is the inventory count, so the number of homes for sale in the U.S., it's just been creeping steadily higher. You can see here over the past year. Now it's at its highest level since 2019. So we're finally back to pre-COVID levels. Can we see further increases in inventories? Absolutely. We're not yet at the point where you would say we're going to see a big decline in terms of prices, but we seem to be at a point that's at least neutralizing the market in terms of appreciation. And we're seeing some other signs as well that are pointing to potential weakness in the housing market. People who are trying to buy a home, they go into contract, they fall out of contract here. So we're seeing 15% of all pending sales falling through in the month of July. That's the highest we've seen on record. We have data going back to 2017 from Redfin. We're also seeing the number of days on the market for homes. So how long does it take to sell your home? 43 in the month of July. That's a decade high. Look at we have to go back to 2015 to see the number of days be that high. And what this is causing, the fact that inventories are going up, the fact that affordability is still very low, you're finally seeing, and this is what we've been talking about all year, was likely to happen, you're finally seeing price appreciation moderate. It's now flat over the past year. So we're seeing the median sales price in terms of homes in the U.S. flat over the past year, lowest rate of growth we've seen in a few years. And if we look at the most populous areas in the U.S., so the 50 most populated metro areas in the U.S., 39 out of those 50 saw price declines in July, with data going back to 2012. That's the most on record. So all signs seem to be pointing to a housing market that's finally normalizing, inventories going up. And looking at that affordability number, there's a few ways it could be closed, but the easiest way would be for home price appreciation to come down, to actually see some declines where it's the least affordable. And of course, it's going to happen that eventually you're going to have that number normalized, because the housing market needs to be based in the long run on what people can afford to buy. So in the short run, you could see that deviation, but in the long run, that gap is likely to be closed. How is it going to be closed? No one knows. Where we're going to have 10 years of very low appreciation while people's incomes grow, so it becomes gradually more affordable, or is it going to be like the last housing bubble that we saw with a more rapid rate of decline? That remains to be seen, but at the very least, you can say it seems to be finally normalizing looking at the U.S. housing market. I want to end with something positive, as we always do. Records are made to be broken, so given enough time, what I always say is every record that's in the market will be broken. We hit a historic record this week in terms of the Dow. hitting an all-time high. First of the year, but broke a record that's been around for a long time. First, I want to give you the backdrop here in terms of drawdowns. And you could see here, this is consistent with history, which is most of the time you're in a drawdown. If you're an investor, I don't care what you're invested in, you're rarely going to be at an all-time high. They do happen, of course, but most of the time you're going to be in a drawdown. And the past 12 years, we've seen a lot of all-time highs, as I'm going to show you in the Dow, but that doesn't mean there haven't been declines along the way. So we've seen bear markets, 2018, we saw one in 2020, that was the biggest decline, 2022, and again this year. So we've had our fair share of big declines in the Dow, but this is the reward for sticking through it, for sticking through those drawdowns, is the fact that eventually the market recovers, and we're now at a place that we've never been in history in terms of all-time highs, which is 13 consecutive years in the Dow. We've seen at least one all-time high in the index. That's never happened before. That's surpassed the legendary run that we had from 1989 to 2000, which of course was the peak of the dot-com bubble. We're now past it. So we're now clearly the best period in history, I would say, for U.S. equity investors has been the last 13 years. You get at least one all-time high a year in the Dow. Obviously, huge gains along with that as well. So just the consistency of it, we've never seen anything like it in history. And we've actually surpassed that 1989 to 2000 run in terms of cumulative all-time highs. We're at 348 since 2013 versus 324 during that epic run. So where we are today, you just have to sit back and reflect it. It's been a tremendous run for U.S. equity investors, not without pain along the way, but a tremendous run, and records, given enough time, every record in market history will be broken. This is probably one that many people assumed would never be broken. You probably would say, if you were looking at the 90s, we're never going to see a market that strong again. But here we are today with the Dow back at an all-time high, 13 years in a row. Okay, I want to end it right there. Have a great week, everyone. If you're watching this on YouTube, hit that subscribe button for all the latest content from us, and I'll see you next time on the Week in Charts.